Hello, everybody. Good morning still. Welcome to the panel, Big Players Investing in Tech Companies. I want to introduce you to the following panelists. We have with us Mariana Gómez, Country Head of Credicorp Capital Chile. She's an MD Legal of Credicorp Capital and Head of the Equity Program at Credicorp. Prior to Credicorp, Mariana was at Carey, the largest law firm in Chile, in the M&A and financing teams. Mariana is a lawyer from Universidad de Chile and has a specialization in corporate governance and international contracts from London School of Economics. Welcome, Mariana. We have also with us Brian Walsh. Brian is head of Wind Ventures in San Francisco, the strategic venture capital group for Copec, which is a leading energy and retail corporation throughout Latin America. Brian has 2 decades of venture capital and startup CEO experience. He's mostly within the San Francisco Bay Area. And prior to Wind Venture, Brian was at McKinsey Company, where he led the firm's external innovation and corporate venturing advisory efforts with global Fortune 500 clients. Brian holds an MBA from MIT and a BS in physics from Tufts University. Welcome, Brian. We also have with us Pascual Cortes-Monroy. Pascual is Chilean-American. He's an investor at Northzone. Northzone is a global venture capital firm with 12 funds and with over 4 billion in AUM. Northzone was one of the first investors in companies like Spotify and Klarna. They have 15 IPOs and 27 unicorns under their belt. Prior to Northzone, Pascual was an early employee at Odd Industries, also called Lemu, an applied AI climate tech startup where he led the company's strategy and space teams. Before that, he was a strategy consultant with Bain Company. Pascual holds a degree in political science and global affairs from Amherst College and Tsinghua University, where he was a Schwarzman Scholar. Welcome again. I am Francisco Guzmán. I am a director of ChileDay. I am also a partner of Carey, and I am very glad to continue with this panel. So let's start with Mariana. Ladies first. Tell us a little about yourself, about Credicorp, and why you're here.
Okay, for those who, first of all, thank you very much for this invitation. Thank you, Invest, and thank you, Francisco, for putting this panel together. For those who doesn't know much about Credicorp, Credicorp is the largest financial group of Peru, also one of the largest financial groups in Latin America. Our holding company has been listed in the New York Stock Exchange for the last 30 years. And we are organized in 4 lines of business. We have universal banking through BCP or Banco de Crédito del Perú, which was a company incorporated 135 years ago, a little bit more. We have insurance through Pacífico Seguros. We have microfinance through Mi Banco Colombia and Mi Banco Perú. We have Prima, which is funds, and we have Credicorp Capital, that is what you all probably know in Chile, that is asset management and private banking. And in 2018, Credicorp had this innovation idea, and it was going through a transformation, a digital transformation. And they realized that making changes within the company sometimes was very difficult. Telling some very successful banker that they needed to do the things different was not an easy task. So they decided to create and launch Crealo. But Crealo was created as a company builder, more than a corporate venture capital. What happened afterwards was that they quickly realized that we didn't have to know everything. We didn't need to do everything from scratch. And there were a lot of opportunities in Latin America that could make our road, to growth and everything easy. So we switched this innovation company to a corporate venture capital. And that's why I'm here, because Crealo is our corporate venture capital, and it has been investing in Chile. We have 30% of our portfolio in Chile, and probably the most known investment is Tempo.
Nice, very nice. Pascual, please, tell us about yourself.
Yeah, thank you very much for having us here and also in such a fantastic location. So I can tell you a little bit about Northzone. So we've been around for 30 years, started originally in the Nordics, and over the years have sort of shifted in shape and size. And today we're global investors with headquarters in London and New York, as well as Amsterdam, Stockholm, and Berlin. And we're early stage investors, but the truth is we invest everywhere from pre-seed, which means someone with an idea and a nice presentation, all the way through pre-IPO. And we do so from a fund that is currently a 1.2 billion fund. That's our 13th fund, and we're about to raise our 14th fund this in the new year. So Northzone, we typically invest in tech companies, so everything from Spotify, which hopefully most of you use in the room. We were the first institutional investors in Spotify, but also other companies like Klarna, Personio, Tier, Spring Health in the US, which some of you might be familiar with. And the model of our fund is quite simple. So we, like a traditional venture capital firm, invest in what we call sort of outliers. And so what that means is we typically make only 10 to 12 investments every year. These are conviction bets where we take around 20% stakes in companies. And the expectation is that every one of those investments has the potential to return our whole fund. So by definition of the 40 or so investments we would make in any given fund, we expect, and this has been the case for the past sort of 13 vintages, that one or two of those companies will break out and will return the whole fund. So that's how we invest. It's risky by definition, but if you are consistent and follow through, we've now returned most of our funds, or all of our funds, for now 30 years.
Great. Brian, please.
Yeah, no, thanks, and pleasure to be here. Thank you for the invite. So we're going to go back to the strategic, to the corporate world. Wind Ventures is a CVC, that's corporate venture capital. The corporate behind it is Copec. If you don't know Copec, downstream energy, fuel distribution and marketing, gas station network, dominant share in Chile and then in 6 other countries. Importantly, the fuel distribution to the mining sector. So very close to not only Chileans' daily lives, but also to the big mining activities in Chile. So an important company. The story goes back, similar timing actually, 2018. Copec was observing the energy transition happen in North America and in Europe. And they asked a very good question. They say, what happens when that comes to our local markets? And they could have taken a couple different responses from that, but they took a very bold response, and they made a very bold aspiration of saying, let's not wait for it, let's actually proactively lead the local market transformations across energy, mobility, and retail in Chile. And so the interesting capability question after that was, okay, that's great, that's very exciting, but now how do we do that really, really well? And that's what Wind is. Wind is, in part CVC, and then in part we've got the Wind Garage in Santiago, which is they can create their own startups out of scratch. They can do some small acquisitions, but for us, they're the partnering team. And the way the model works for us is to fulfill that aspiration of leading the local market transformations is let's attract the world's best startups. They could be in Chile already, or maybe they're in North America, or maybe they're here in London. But let's attract them to Chile for the benefit of all Chileans to work with Copec, and we can give them capital, right? That's how we attract them here. So we're giving them the promise of growth plus capitalization. So it's very much a global to local model. We call it, sometimes we call it the global innovation bridge to Chile, something we're very proud of. And for the investment strategy, we're usually doing a bit later stage. We're doing Series A would be the earliest. I prefer later stage because we're doing the cross-border stuff, and so later stage for healthier partners and all the rest. But at the end of the day, we're offering, I think, something that's quite distinctive and compelling in terms of value beyond the capital. It's that unfair access to the region through Chile, through a world-class strategic partner, Copec. Fast forward to today, we have deployed over $160 million on this model. We have a portfolio of 25. Again, this is across mostly energy, mobility, and retail. Performance has been very, very good despite all the different cycles, which maybe we'll talk about a bit later. But it's been a lot of fun. It's been very fulfilling work, and we're always looking to enhance that value, right? How do we actually offer more to global startups to come to Chile and to Latin America? So,
Great. All of you have great backgrounds and are doing very interesting stuff. And some people in the audience, some are experts in VC, some others might be new to the asset class. So there is this kind of myth in VC where you might have the discussion, okay, but what are you looking for? Profitability? Is this altruism? And maybe you are looking for other things. Are those things mutually exclusive or not? So what would you say about that to someone that is new to venture capital? I don't know who wants to start. Brian.
Well, so I think the first thing to know is sort of a synthesis of what just happened here through the introductions. We have one private venture capitalist here who probably offers yield. I'll let him speak for himself. But then you have two corporates which offer something totally different, right? It's corporate strategic engagement to startups for something that's strategic. Sometimes that's a window of opportunity into new tech trends to actually filter that into executive decision making. Other times it's more like the win model. Hey, let's find really good partners to do partners locally to drive new revenue and EBITDA, right? While we give the startup growth prospects in a new region. So I think it's different. And I think the way I always start this, and it's funny how corporates will come up to me and say, hey, I think I should do a CVC. I ask the same question. What do you want out of it? Because that will then guide you on how you should do it. And so you should always ask, even if you're a financial investor or on the corporate side, what is my objective? So I sort of flip it back to them. What is your objective? Do you want just yield? You got to talk to this guy right here. You want to you want some strategic impact? Well, that's on the strategic side, a little bit different skill set, a little bit different team, and happy to talk to you. But that will help guide the KPIs and all the rest, how to manage it. Yeah.
I agree with that. And I mean, for us, as returns plus strategic. I mean, there's no option, one or the other. And I think one of the things we've learned is that, for example, 90% of our companies do work together with other companies of the Credicorp group. And that means they're working in development, co-creating strategies. So I think the strategic side is very important, especially in the financial sector, which there's still, you're looking at a long time. We were talking beforehand, and you need financial inclusion. So there's long-term investments that can give you a broader client, but in a long term. So I don't think it's one or the other. You can have both, and that's what we are targeting for.
Mm-hmm. And now what about the pure VC focus?
Yeah, so maybe the easiest way to sort of understand our model is also understanding our funding structure, right? So we operate like a traditional private equity firm in sort of a 2-on-20 model of management fees and carry, and our investors, our LPs, are typically endowments, pension funds, large family offices, and therefore there is an expectation of IRR at the end of the day. Many or most of our LPs have been with us for multiple vintages, and at the end, our model is rooted around, we'll deploy over 3 to 4 year cycles, and then there's an expectation that our funds will perform in top quartile. So in venture capital, top quartile is obviously depends on the vintage, but it's somewhere in between the sort of 35 to 45% IRR expectations. And that, how do we achieve that? Basically the day-to-day is, and this was quite different to what I thought venture capital would be when I joined, which is I thought I would sit there and these great companies would come through the door and we got to pick the ones that we thought were most interesting. But it's quite different. So for example, on average every year we look at between 6,000 and 8,000 companies as a team. We're a team of 20 investors globally. And of those, we invest, as I mentioned, in only 10 or so. So that's 0.2% of the companies that we end up investing in. Those that we invest in, as I mentioned, we expect and we support with the expectation that those companies will exit in a window of like 10 to 12 years. Most commonly, that has been through an IPO. Actually, 3 days ago, we had a company go public called Klarna that maybe you read in the news. So we were investors since the Series B and one of our biggest positions there. So yeah, that's how it works for us. There's definitely, it's a for-profit model, and of course we try to support, and we always look for other synergies and how we can create impact. But that's ultimately our model.
Great. I like the idea that it's not the one or the other. At the end, it's both, but with different focus and priorities. Pascual, you mentioned when you introduced yourself that in each fund you expected that just one or two companies could be the ones that give the return to the whole fund.
Yeah.
Tell us a little about that.
Yeah, sure. So in any given year, as I said, there's around 10 to 12 investments for the whole fund. That means any given investor like myself would make at most 1 or 2 investments. And that means that whenever we invest in a company, we need to believe that that company can return the fund. But what does that mean? That means that the market that they're going after can support at least 3+ billion outcome. Because if we're holding 10 or so% after dilution of multiple rounds until exit, we need more or less. Our current fund is 1.2 billion, so you can do the math of more or less what we need, and that's just for us to sort of return our fund, and then upwards from there is where we make our real gains and our investors too, right? So an example is Spotify, for example, which is currently, I think, at about 140 billion market cap. So we were the first institutional investors there. When that investment was done, the partner that did that investment, did not have a great track record. He was running out of bullets, and it was actually a very controversial decision. So the way our investment committee works is it's non-consensus driven by design. So what that means is, if I bring forward an investment to our investment committee, we have a long discussion. Obviously, there's weeks of work leading up to that, but we then vote as an IC. But that vote, which ranges from 1 veto, which has only happened once in 30 years, to 4, we absolutely must do that investment. We take the average score of the group, and that is just one more data point that the deal team looking at this investment considers. Because interestingly, some of our most successful investments have been the most controversial ones in our IC, and some of our worst investments have been the most consensus. So. Oh, really? Yeah.
Wow. And in the corporate side, because the corporate side traditionally comes from a more, traditional entity with a corporate governance. They might have never done VC before, and you make 3 investments and 2 go down quickly. I have seen that scenario in some corporate ventures. What do you think about that? I guess you have had some bad stories, good stories. How do you deal with that?
Well, we have, of course. We have had bad stories. And I was talking to the team of the Crowley team, and they shared with me different comments about it. And they said that if we didn't have bad stories, then we were not taking enough risk. So we needed to have bad stories because that's part of the process. And we expect to have bad stories. But those bad stories have to have lessons learned. And I think that's the takeaway. Every time that we have failed, we have a really good lesson learned. And it helps us, for the next investment. And one of the things we appreciate, for example, is that we like to invest in founders that already had a previous experience, even if they failed. We have come across that if they failed before, they probably will be more successful the next time. So I think failing is part of being investing in venture capital. You cannot expect to have 100% success.
I think it's very useful to hear that, especially for the audience, because we have all seen some cases that the first investment goes wrong and some people just pull out immediately. So what do you think about this, Brian?
I totally agree, and I'll just put some numbers to make it, perhaps bring it to life a little bit. But if you think it's 50% of all startups fail going from the seed to the A stage, and then 50% fail going from the A to the B, and also 50% B to the C, and C is growth, right? What we've done here from seed to C, growth, is we've gone from technology, okay, a startup has developed technology, now you have to cross that valley of death, we sometimes call, and to create a technology company with positive unit economics selling that technology. That's an incredibly difficult thing to do, right? And if you do that failure rate calculation, about 6% of all startups make it to the growth round, make it across that valley of death. Okay, so the nature of venture capital, it is all about risk. In fact, I think, correct me if this is sort of old, but on the financial side, and I think we adopt this on the strategic side too, the expectation should be that a third of your portfolio fails. It could be quickly or not quickly, but fails completely, lose all your investment. Another third, you get your money back through some sort of liquidation process. So that's a fail too. So 2/3 fail. And it's the 1/3 where you make a profit, but it's 1/3 of that 1/3 that makes the big return. A couple in your portfolio and returns everything. So it's incredibly difficult to find the one that returns the whole fund. And that's why VCs play this portfolio approach. You have to build a diversified, large portfolio. And actually, and a lot of people don't talk about this, but there is a second layer of diversification VCs play. They stack funds. Not every vintage, which is the year you start a new fund, will behave the same. Geopolitical things change and can impact startups and COVID bubbles and busts, right? And so you stack funds and you build large diversified portfolios. So you have two layers of diversification, and that's typically, in very simplistic terms, how VCs, I think corporate and financial, manage the really high risk to deliver.
Yeah, I would maybe add that because venture capital is a business of outliers, it's also really important, I think, when you look at the industry, to not look at the median or the average indicator, because that's by definition not what you should be looking after, right? So to put some numbers in perspective, of the average company we invest in, I think I totally agree, it's more or less in that range. If you take, for example, hedge funds, right, which were cousins of ours, if you will, later stage public equities, if you invest in the average hedge fund, you're much better off investing in the S&P 500, right? That's a well-known fact. That suggests that you should only invest in the best performing hedge funds if you actually want to beat the market. I think there's a very similar dynamic with VCs, where the performance of the average VC versus the top quartile VC is a sea of difference. And the reason why that's particularly important in VC is that you deal with something that I would call sort of access illiquidity, right? So unlike public equities, where you could be really smart about your perspective of the macro, or you think a stock might be undervalued, and so you can make a trade. A large part of the sort of alpha that VCs look for is one of access, right? So what that means is if you're not the top brands, it's very hard to get access. And so that there's almost like a self-fulfilling cycle, both on the lower quartiles of performing funds and the top quartiles of performing funds, where you will get better access because the top performing founders and entrepreneurs will go after the big brand name. So there's a lot of layers to it, but ultimately, it's one where there's sort of these network effects that start to kick in as you approach and maintain upper quartile performance.
Yeah, I like that idea, and I agree with that, because when you say, I don't know, 7 or 8 companies from 10 fail, yeah, that's right. But you see the same guys going successful, and they have different ratios at the end, because there are some that fail 10 of 10, and some others have, I don't know, 50% of the fund and do okay. But okay, following this idea, venture capital is hard, very hard. It's risky, like what you said, Brian. Aligning the stars is very, very difficult. Then why you do venture capital? Like,
why do I do it?
I mean, what should anyone do venture capital, given that it's so difficult?
Yeah.
Well, the thing is that we've seen venture capital as like our future growth path. I mean, we see that we are not able to bring technology or disruption to the business if it's not through venture capital. So, and Crealo has one of the purposes it has is not only looking to expand the current business that Credicorp has, but also looking into future business or future markets in which Credicorp can invest. So we're not able to do that within the company. We need to do that without a venture capital branch. So I think what we haven't found another way to do it successful that is not through Crealo. So I do think, and we strongly believe that the idea of having this branch that is capable of going around, of experimenting new technology without jeopardizing your core business is really fundamental for the growth of Credicorp at the end of the time. I think that's why we are in it.
Yeah, I mean, for me, it is difficult, but it's very fulfilling work. On the corporate side, where I've been I started in the private side. I've been in the corporate side for the last 20 years. It's typically linked to corporates that need to transform in some sort of way, which is incredibly difficult to do. And I've had some experiences before starting with Wind where there wasn't the right team in place and there wasn't a lot of results or impact, and that was a terrible place to be. I said, this is not worthy. And so for me, that was when I went to McKinsey. Say, let me just level set on what good should look like and all the rest. And then when it came time to where I met Leo, who's out here, and the Copec guys, I said, this is a wonderful company with really bold aspirations. I think if anyone can do this really well, it's probably this company. And so I was really excited to join them. And the way it's played out is that we've won a lot of awards and all that stuff, but more importantly, I think we're adding real impact and contributing to a corporate innovation that is going at a pace I have never seen before. And so every day the work is different, and every day the work is quite fulfilling. It's difficult, but it's fulfilling work. So that's the short answer.
No, and just to be clear with the question, I am aware it's difficult, but I am also a huge fan of VC. So it has very good things for all what you have said, and also because Pascual,
I'm sorry to add, but there is also contribution to our countries. I mean, because when you invest in this kind of startups, there's also an upside for the country as well, like in financial inclusion, as I mentioned before, and there's a lot of things that also the country gains from this. And so the contribution is not only for ourselves, but also for in the places we are.
Okay, and going that way, if this were purpose only, growing the country and benefiting other areas of the business, would VC be sustainable? What do you think, Pascual?
I don't think so. I think we need a combination, right? We need a combination. We need a mix of people like we have here, because that's how it works. You need the type of capital and the type of returns, however you want to define returns, that a corporate or venture capital looks for, because I think the ecosystem needs that. There's that lifts everyone up. But if I go back to your original question of why do I do venture capital, and why maybe some people in the room that might be prospective LPs should consider venture capital as part of their portfolio allocation, I would say two things. On my side, it's definitely self-serving in the sense that it's an incredible opportunity if you think about it. My job is to meet people that, despite all the terrible odds that we've described, put everything on the line and are convinced that the future should look like the way that they envision it, right? And that's an incredibly inspiring sort of day-to-day. In the morning I meet someone that thinks transportation should change, and the afternoon you meet someone that thinks healthcare is broken, and I get to ask pretty basic questions and learn, and it's, to me, there's a huge privilege in being in that position. And of course you can take, and you do take, a sort of thematic or thesis-led approach to investing. For example, a lot of what we're doing today is around specifically voice AI, and we can talk more about that later, and some of the investments we've made there. So that's sort of what gives me energy in this job, and why I love it so much. On the other hand, why should LPs be in venture capital? There's the boring sort of portfolio allocation and diversification, which I think is a very important argument. And then the other one, if you think about sort of what we're living through today, and I hope we talk about this, right? But it's easy for me to say AI and everybody sort of looks the other way, and I've heard it a million times, right? But the truth is, and I can talk through some concrete examples, what we're living through right now in terms of value creation, revenue growth, retention, real businesses being created and value being delivered is unlike anything I think any of us has seen before. And of course, there will be some big failures and all of that. There is a lot of hype and for sure. But I think net, the way things are going are unmistakable. And so what does that mean for you? You know, if you're an LP that wants exposure to those trends, today you cannot do that in the public markets. You can't really do that in the private equity markets. So you need exposure to early stage companies that remain private. And by the way, private companies are remaining private for much longer. So if you actually want exposure to that, you know, venture capital is one of the best ways you can get that.
Great. So my takeaway hearing you is that profitability is key. It can go hand by hand with purpose and impact,
yes,
and brings a lot of very good externalities along with it. But sustainability is key at the end.
I would just add on. I think I like the argument for the financial LPs to jump on, but given what's going on with AI and everything else in robotics, I think there's a similar pitch to corporates. Frankly, you know, the rule of thumb, the simple rule of thumb is, hey, if the outside world is changing at a faster rate than what you are witnessing inside your four walls, probably a good idea to engage startups to at least understand what's going on, so you're not blindsided. Right? And again, there's a lot of different ways to engage. CVC could be one, a scouting team could be another. But just as a strategic capability, if at all what's going on in AI has any, it'll be sort of, I don't know, I don't know if I could think of a case where it wouldn't be relevant, but if you do agree that it is relevant, robotics, clean tech, climate tech, health tech, fintech, any of that stuff, is at all interest where all of your executives inside your corporation could gain value by just learning what those trends are as a background or a framing around what decisions they make. Engaging startups or investing into a fund that would share deal flow, that's a different type, would be something to consider. And I raise it only because I do agree with you. I think the rate of change we're seeing now and will see over the next 10 years, it's going to be faster than what we've ever seen before. I go into the reasons why, but you know, now would be the time to sort of think about how are we going to secure some of that insight and bring it in-house.
Yeah, and tackling on that, you can compare the cycle between 2010 to 2020 and what those guys did with barely internet, no AI, like not that many investors. And what might happen now in the new trend with all this new technology is quite overwhelming, just the idea. So how do you see that? How do you see the, and also adding to that, we are supposedly in a really bad time for venture capital. Like we have had 3 years with—
I disagree.
I like the idea. So as some president said, no hay plata, there is no money. Okay, that's what many VCs say. How do you see the cycle, where we are, where we're heading?
I mean, just to address this, the last point, in the last 3 quarters, there's been more investment in venture capital than I think it's 4x that of the 3 years ago. So, you know, it's definitely an unprecedented level of just liquidity injection in the asset class, at least in Europe and the US.
But do you agree that there is a restart?
Yes, absolutely, and I think that's for sure true. And you know, if you look at it from 2010 to 2020, we saw this sort of age of maturity of technology where you had low interest rates, you know, raising capital was relatively easy, companies were growing, the internet was, and mobile was sort of penetrating, so it was, you know, almost anything you touched grew. And then we had this sort of age of exuberance between 2020 and 2021, catalyzed by COVID, where, you know, expectations ballooned. We all saw the crazy rounds that happened, also in Chile and in everywhere, and things, including, you know, our portfolio, sort of contracted from 21 to 22. There was a reverse to unit economics, to profitability, to being efficient, and then we're at this point now. And why do I think it's different? I think it's, you know, it's very concrete, and we can debate about whether how incredible AI is and whatever, right? But I think there's 2 facts that I would, if you can take away from this conversation, I would know, which is, one, the penetration of technology and the internet. So a concrete example, right? So Uber, it took Uber 6 years to get to 100 million users, okay? because mobile was not fully penetrated, 5G was not fully rolled out, 6 years. It took ChatGPT 3 months to get 100 million users. So there is a tech ubiquity where technology can propagate at a significantly much faster rate. And that's not going to change, right? We're already there. And then another fact is infrastructure investment. So there's around 1.8 billion in infrastructure development on the data center side in the US every day. That is not going away. So that's CapEx that's being invested that will support the next generation of foundational models, and we can talk about that. That isn't going away. So, of course, there is exuberance still. When you see an influx of capital like we're seeing now, there will be big winners and there will be big losers. But I think there's these sort of fundamental structural changes that set up the stage for success in a way we haven't seen before.
I think in our experiences was a little bit different because COVID actually helped us. I mean, a lot of, in many of the countries we worked, Bolivia, Peru, not as much probably Chile and Colombia, but they were very far behind in everything that was fintech. So the need of this fintechs during the COVID area was very, very important. So it accelerated, and a lot of fintechs appeared at that time. So we had a lot of opportunities in the market, and we were able to accelerate a lot of changes. And so it's been like good years, I would say, instead of not bad years. And for example, Tempo has already more than 2 million tempistas, how they call them.
Yeah.
So I think we haven't experienced that constriction because there was opportunity of growth for the fintech market, I would say.
Well, confirming that, I mean, the numbers confirm that the period of exuberance until 2022 in Chile and our countries from the region, they continue growing in VC until 2023. Okay, and just in 2024, there was a decrease in investment, but at least in Chile, it was a record year in exits. We have 20 exits in Chile in 2024. So that cycle that you mentioned, which is a phenomenon that is very local, it has been quite important. So I agree. Brian?
Yeah, I think when you ask just generally, are we starting a new cycle or not, I think you've got to start at it from what is your sector focus, right? So generalist, fine, generalist, you'll sort of adapt. But for us, we have a certain focus on energy, mobility, and convenience or retail broadly. And so how does it impact that investment strategy? I would say both good and bad. Part of the current cycle is policies that do not support new energy adoption through subsidies like the previous U.S. president did, right? So that's a big change, and frankly, that's killed a lot of U.S. Startups. And so now, as we sit here in London, London's now the climate tech startup capital of the world. You can measure that. So I'm spending a lot more time out here. So that's difficult, right? Now, the counter to that is interesting because data centers need to be powered, and renewables and batteries are the quickest and the fastest and the cheapest to do that. And so there's still that trend, and there's still opportunities there. But it certainly is different, and it certainly has impacted some portfolio companies negatively. On the robotics side, which is certainly in our wheelhouse, I will say I share the excitement. I share this is probably going to go on forever. The perfect cycle for venture is one that starts and is fairly stable for 10 years, right? Because if it doesn't, and let's say it pops after 4 years, some people will make money, but there'll be a lot of people that lose all their money, right? And so we'll see what happens. I think just like any business climate, venture capital really does excel when there's sort of a long sort of stable environment where you can get in at a price and you can rationalize what the exit price is, and there's no sort of disruptive change or changes in between the start and the 10-year liquidity date. So that's my hope, is that we're on for a long cycle.
Nice. You said something about climate tech. In Chile last year, I mean, there are many verticals that are relevant in Chile. Fintech is the number one, but climate tech last year was the second most invested asset class. So there is something going on there, and Chile has it is a great place to do it, to invest and to develop projects.
We bring a lot of really high quality startups in climate tech to Chile. It's part of our model. I think Chile, we've heard it from prior speakers. Chile is just a wonderful testing ground, proving ground, gateway to a larger region. So I expect that to continue for sure. The U.S. climate tech, I'll put it this way. In the last 12 months in the United States, 70% of all venture capital has gone into AI or related. Mm-hmm. Yeah. That's deal value. So those really big deals into ChatGPT and all that, it sucked up all of the capital. So that tells you something. San Francisco is all about AI. And they want to be the center, and they should be. But it's obviously putting climate tech in San Francisco in the United States at a much lower level than it was, honestly, just 12 months ago, 18 months ago, right? Before Trump got in.
Okay. Yeah. So we'll be mentioning AI. What do you think about AI as investors? Because someone said that you hear the phrase AI and people look around, okay, again AI. What do you think about AI? Are you looking to invest in AI, something that you look far away from?
I think we're doing right now, we're not looking to invest in AI directly, but we are asking our startups to show us how they use AI in their business. And this is a must. It has to be included. It has to be included in customization. It has to be how you get to the clients. For example, we just invest in a startup in Mexico, and this is for loans. And it's getting to people that very small village, they don't have prior credit records, and there's a bot. They can interact with the bot. And there's artificial intelligence that uses the information that is collected by the bot to make the loan application. So that's a way that we know that AI is integrated in the business. And so that's what we're looking for. We're looking for startups that they used AI in their business, but not to invest directly in AI.
What about you?
Yeah, I can give our perspective. So maybe to make like a bit of a framework for how we think about it. So on one hand, you have foundational AI companies. So you can think of OpenAI, you can think of Anthropic. These are companies that are developing large language models that have sort of horizontal use cases, right? You can use it for anything. There's hundreds of billions required to train those models, and sort of bigger is better in that world. We think that when it comes to horizontal models, that's not where we are focused. So for example, in Europe, we have Mistral. That's not where we would be focused, because we think the hyperscalers like Google and Meta have a real sort of right to win on that horizontal layer. Where we have invested in this foundational part is in verticalized foundational models. So we have an investment in a company called Cusp AI that is focused on foundational models for material science. So they're developing molecules for use in pharma and in material discovery. Very specific, world-class team doing that. We also invest in a foundational model for image generation, so very specific. They just announced a $150 million contract with Meta, because they have these incredible team of researchers and they've been able to sort of outperform the state of the art. So that's the foundational world. Then you have sort of application layer companies, which are companies that are using AI from the foundational models to develop some kind of service, right? And maybe the best way to explain it is give you a couple of examples of companies we've invested in this year. So one of them is a company in Spain called Murphy. And so Murphy, what they do is they automate debt collection using voice agents. So you can, if you haven't tried this, I would encourage you. But today, the state-of-the-art AI voice models are indistinguishable from reality. And so what Murphy does is that it works with large banks to collect non-performing loans, particularly low-ticket loans. So historically, you would send or sell your loans to a collector, but obviously they would go after the biggest tickets, and they would have a call center do that, and that's really inefficient. So Murphy overnight can do 100,000 calls, even chase the sort of $10 outstanding loan, and deliver value overnight, right? So that's Murphy. Another example of a company we're looking at today is on the recruiting side. It's really interesting. So how do we go? We all went about looking for a job. We maybe applied on LinkedIn. We maybe sent a CV. It's a really painful and friction high process, right? On the employer side, you want someone that had an MBA maybe or went to this school, and it's like a marketplace that's very asymmetric and inefficient. And this company, what they're doing, again using voice agents, they have a voice agent that you call. And you have a 20-minute conversation where you can tell them about where you are in your career, what are your aspirations. You give a lot of color that's not captured in your LinkedIn or your CV. And then on the other hand, there's a voice agent that also has a 30-minute conversation with an employer of what kind of person they're looking for, what's the culture like in the firm. And this company is building a sort of a market maker or a clearinghouse that's able to capture much more nuance of both sides of the equation, and then offer the employer, hey, here's 10 people that are very specifically selected that we think could be relevant for your company. So foundational application. And then finally, and sorry, this is taking a bit long, finally, like traditional companies that are using AI, and that's probably what you've seen most in the news these days. The example of Klarna, which is the company in our portfolio that went public 3 days ago, they replaced their internal customer support function with chatbots and AI agents, and that had a massive impact in their ability to turn profitable this year ahead of the IPO. So I think you can have all these different types. Obviously, we're very excited, but one more thing I would say is I don't think this is going to be stable. I think there's going to be a ton of volatility, which is why if you participate in this market, you want to do so with investors that have seen the cycles and can navigate through the noise. And then the last thing is I think we're optimistic in terms of macro. If you look at the S&P 500, I think it's 97% of IT companies have outperformed their EPS expectations in the last quarter. So I think it's not like the fundamentals are not there.
Interesting what you said specifically about the recruiting company, because when I read about that for the first time, I said, that doesn't work. Come on, like you speak with a bot, whatever. Apparently the matching rate, the success rate in hiring is much higher than using traditional models. So it's quite impressive. Brian.
Yeah, we're certainly following it. So I would characterize the AI wave as mostly consumer-based with the ChatGPT and sort of people playing with it, bring it to work and adding efficiencies and playing around with the agent mode and doing agentic AI. And I think that will continue. But what's happening under that takes a little bit longer are the corporate use cases. Be it the call centers where you can have a co-pilot and you can have a call center that with 100 human beings and it can act like a 200-person call center, right? So now you've decreased the capital efficiency or increased the capital efficiency by 100%, right? So that you don't need to build another call center. You've done it right there. HR, all really corporate functions have a large and growing group of startups trying to add AI benefits and efficiency to it. And the so what of all this is sort of the last thing you said, the EPS. So I'll spill that out a little bit. Let's just say that these corporate AI use cases, they cut OpEx of a corporation, 3 to 4%. That, there's some assumptions in this, but that can equate very easily to a 12% improvement in EBIT. It's massive, right? And so this is happening, and I think we're just now entering where we're going to see this on not only the public companies announcing improvements in that from AI adoption, but startups running their own teams and systems in super lean ways using AI, right? And so they'll need less capital. And this is actually something we haven't talked about, but I think the startup of tomorrow versus startup today is going to evolve to be quite different and need less capital, be leaner. And as funny as it sounds, but McKinsey's out there already saying this. If you're a manager of people, you need to start managing your people and your digital agents equally. You need both. You need to actively manage both. So that's the world we're entering into. Massive impact, changes in management. This is coming. And for our role, we serve Copec, and so we will be investing, we will be engaging, and we want Copec to experiment with all of these different models for all of these different use cases so that they can make the best decision of what works best and what can be scaled out with what teams.
Great. We have not that much time left, but we still have time. Would you like to tell us about, I don't know, a home run and a failure, something great and something bad that you have experienced as investors in VC? Who wants to start?
I can start. So, maybe start with a failure. So we invested at the at the seed in a company in the UK called Hopin. That's a company that went in the span of, I think, under 18 months to an 8 billion valuation. So you can imagine that it was very easy for us to raise a fund on the back of that TVPI. But that company then quickly so what Hopin did was sort of imagine like a Zoom, but for sort of big conferences and in-house teams. That company, went to basically became a write-off. They returned some. They had raised so much money. They had raised, I think, over 500 million that we ended up getting some money back from because there was just cash in the balance sheet. But that company sort of crashed because the market changed. Fortunately, we were seed investors, so not that bad. But if you're a General Catalyst that invested a 6 billion valuation, that definitely hurt. But that was a big failure for us. And then. And by the way, I think failures are really important, as you said, right? Otherwise, it's very hard to learn. And then on the successes, I think maybe if we talk about Spotify, we talk about Klarna. I think Personio is a good example. Personio is like an HR platform. I'm pretty sure in Chile there's one. I forget the name now, but it's sort of this all-in-one operating system for your HR side of the business. And yeah, it's a company that. We invested in the Series A, and that was started by Hanno. He was out of university. He had never worked at had never had a job before, and Hanno is today he's running this company that was last valued I think at 6 or 8 billion. It's a company that is in the hundreds of millions of revenue, and importantly, it's very retentive revenue. I think as you navigate sort of the new AI companies. I bet everybody's board is very excited about implementing AI, and that trickles down. So if the board says, "Hey, we need to invest more in AI," then the head of product says, "We should try AI," and they take all these demo codes and they try all these products. But that is sort of almost marketing revenue, and it's not retentive. So we really look for companies that have strong retention after 12 or 24 months from customers, which suggests that they're actually delivering value to the end customers.
Great, Brian.
Sure. Yeah. So, mistake. This story I'm about to tell happens in venture. You want to learn from it and never have it happen ever again. This is way before I got to Win Ventures. So I was sort of a junior partner at a private climate tech fund, and so we did a long diligence with this complicated deal. It was a roll-up strategy, trying to play PE. We probably shouldn't have been, but nevertheless, we close the investment. And we go to the first board meeting, and we start reporting out, and the numbers are not consistent with the numbers that we had from diligence. And we asked, "Hey, CEO, what is going on here?" And he said, "Well, this is the company's numbers, and I think what you're referring to were the investor numbers that the CFO put together." We're like, "Okay." So there's 2 books, all right? This is a big problem. Anyway, so that was a painful one. From day one, that was painful. And we did the best we could, but the company, it didn't go anywhere. The successes largely come from what we're doing at Wind. I think we have a pretty unique model. We've got 25 investments. I think we've got 12 or so meaningful partnerships with these global startups, or again, some of them from Chile, going reasonably well. One of them I'll highlight was Wallbox, is a Spanish company. We sold them on Chile. They weren't thinking about coming to Chile, but through us and our Wind platform, they came on board. They liked it. We partnered them with our e-mobility company called Copec Voltex. They quickly gained 40% of the market share in Chile through us. Win-win for all. And what Wallbox did was leverage that momentum to put a country manager, a regional manager for LATAM, and expand on their own, using Copec use case, and expanded well on their own. And then they went public through the SPAC. This was during the SPAC phase. Wow. And they did quite well through that. And the revenue contributing from LATAM was a meaningful part of that, right? And so it all worked to where it was all very, very value add. And and at the end of the day, it was by venture metrics, a 10x return on the investment. So it was great.
We had an experience with a marketplace platform
A good or a bad experience?
No, a bad experience. The bad first. It was the meat of COVID, so we wanted to go really fast with marketplace platforms. So we invested in this, and we got in a partnership with this startup, and it didn't go well. And I think one of the lessons learned also here is that you don't have to fall in love with the idea, and you have to walk away at the precise moment you know that it's not going to work. And sometimes that's hard because you haven't invested money, you haven't invested time, and you want it for it to work. But you have to learn that. You have to walk away at the time, even if that's, you're going backwards, and then you don't have like a plan B. So that was a hard lesson learned. And I think successful, we have been very successful because, as I mentioned before, 90% of our investments are already, really working closely with the companies in Credicorp, just in insurance or microfinance or Credicorp Capital. But I think probably we're very proud of Tempo. I think we're thinking that this, and Solange is not here, it's in the other panel, but we're waiting for the CMF to give it its banking license, hopefully this year. So it will be operating as a bank in the next years. So for a company that started from scratch, I think that's very, very successful.
Yeah, it is a great story indeed. So I think we're on time. So I just want to say thank you everybody for coming first. It is very impressive to see this room with all this great audience sharing with us this moment. Thank you to each of you of the panelists who took the time and did their work. You came very well prepared. And to give you a final idea, in case you don't know, 70% of the companies in NASDAQ have been financed by venture capital. And 40% of the companies in Fortune 500 have also been financed by venture capital. So this is why this is such an important conversation to have, showing the difficulties, the unique of the asset class, and also the opportunities that are here. So thank you very much to the panelists, and thank you for coming.